Good morning, everyone, and welcome to NYSE TV Live. I'm Kristen Scholler here in studio at the New York Stock Exchange. Well, stocks are coming off their strongest session since November as inflation data revived hopes of rate cuts and as solid bank earnings set a positive tone for this earnings season. Well, inflation rose 2.9% in December on the back of a jump in gas prices. Price acceleration for other goods was muted, though. And the Federal Reserve will use these inflation inputs when it meets next at the end of January. We'll have more on retail sales in a moment, too. Let's take a look at what's on tap in today's show. Well, banks kicked off earnings season with optimism, with more firms like NYSE-listed Bank of America and Morgan Stanley reporting their latest figures today. We'll speak with Chuck Lieberman, Chief Investment Officer and Managing Partner at Advisors Capital Management, about what he is seeing across the sector. And while this year's College Football Playoff National Championship game between Notre Dame and Ohio State doesn't commence until Monday, the event will enter the spotlight at the Stock Exchange today as the playoffs executive director is going to ring the bell and kick off our session. Meanwhile, FlowCo, which provides solutions for the oil and gas industries, will start trading on the stock exchange today. And I'll be joined by the CEO, Joe Bob Edwards, about this milestone and how meaningful ringing today's closing bell will be. While it's been a busy week for economic data, the December wholesale price and consumer price data out earlier show that investors do have more data points to evaluate, and that is the December retail sales data out this morning. According to the Euro Census Bureau, retail sales climbed 0.4% month on month in December. They were up 3.9% in December from the same time a year ago. It was solid growth, not too hot, not too cold amid the holiday shopping season, and of course, a decent economy. Well, joining me now with more on these markets is Kevin Montes, President and Chief Investment Officer at Hennian and Walsh Asset Management. Kevin, it's great to see you, especially in the new year.
It's great to be back. Happy New Year, Kristen.
Happy New Year to you as well. What do our viewers need to know as we start this new year in the markets?
I think the beginning stages of the new year have provided investors with a glimpse of what 2025 may look like overall. More uncertainty, more short-term bouts of volatility, some rotational shifts in terms of market leadership, and overall, what's likely to be a good but not great year for the stock market.
Of course, the market coming off of 2 years for the S&P of 20% plus gains. I think 55% is how much we had seen it gain from 2023 to 2024. Kevin, talk to me more about this sector rotation that you anticipate.
And going back to that 2-year theme, there's been 9 times since 1950 when the market has rallied by 20% or more in consecutive years. The good news, Kristen, is that the following year has been higher in 8 of those 9 times. The bad news, perhaps, it's only been higher by an average of 3.6%. So investors need to be a lot more selective to find those pockets of growth opportunities. And I think you're going to see them in some smaller cap areas, such as regional banks. Big banks are off to a great start to this earnings season. I think that trickles through to the regional banks. How about small cap biotech? I do anticipate a pickup in M&A activity in the new year, and that's going to benefit those smaller cap biotech companies with all of these innovative healthcare solutions.
Certainly the biotech space has been waiting perhaps for a little bit of buying activity of late. Kevin, of course, 3.6% is pretty much what people can get in a high yield savings account now. So you mentioned obviously being able to weather some of the storms if we do get bouts of volatility, all in higher. How does this economy look to you, and how does that shape the Fed's rate policy?
Yeah, I think right now the economy looks relatively stable. If you look at the Fed's most recent summary of economic projections, they're expecting the economy to slow to just 2% growth this year and continue at that 2% rate all the way through the end of 2026. Still growing, but yet slowing. I think what we learned, at least over the last 3 days, is that we saw cooler inflation prints and a relatively robust jobs market. If that holds true, the Fed doesn't need to do anything right now. In fact, I don't think they do anything in the first quarter of 2025. And they're only forecasting 2 rate cuts this year of just 25 basis points each. I think that's going to hold to be pretty accurate.
Yeah, we've seen traders certainly adopt that notion as well. Other themes that you're anticipating for 2025?
I'm not abandoning the AI revolution theme just yet. I don't think anybody should. I know everyone wants to talk about NVIDIA, but there's plenty of other opportunities within AI ecosystem. Kristen, whether it's related to the software software companies? How about the data centers, the cooling solutions that those data center needs, and the tremendous need for energy that those data centers occupy, whether it's electricity, natural gas, or now, as we're finding out, nuclear power. And all of that generally comes from multi-utility. So look to lean more into the utility sector in the new year as well.
We have an IPO here at the New York Stock Exchange today,
Wonderful.
FlowCo, an energy provider that we'll see ring the closing bell. Hopefully some price opening action about midday or so. What does that signal to the strength of the market?
I think it's just another example that there's more optimism in capital markets in the new year. I think you'll see more IPO activity. I think you'll see more M&A activity. And I think you see this overwhelming, resounding notion that the economy should grow from here. It's just a question of how much it's going to grow. And I think investors do need to temper their expectations for how much the stock market can deliver in a third year following 2 consecutive years of 20% growth. But if you're in an environment where interest rates are coming down, inflation is moderating, and the economy is still growing yet slowing, that's a pretty fertile ground for both stocks and bonds.
Are there certain stocks on your radar?
Yeah, I'd say there's 4 that come to mind. First, as it relates to the AI revolution, a cooling company called Modine Manufacturing. As it relates to aerospace and defense, we're going to see more and more defense spending. How about the largest defense contractor in the world, Lockheed Martin? Smaller cap biotech, I like Axum Therapeutics. And then finally, around smaller cap regional banks, I like a company called Webster Financial. They have a dividend yield of just under 3%, a PE of just 10, operating and headquartered at Stamford, Connecticut. I see them as a potential consolidation candidate.
Interesting. And as this earnings season rolls on, Kevin, any nuggets that we can perhaps glean as to where certain sectors or even names might be heading?
Yeah, the most important thing coming out of this earnings season, and right now it's forecast that there's going to be an 11.7 year-over-year earnings growth rate for the S&P 500. If that holds true, that's the greatest year-over-year earnings growth rate in 3 years. But we need that earnings growth not just to be led by the Mag 7, not just to be led by the information technology sector. We need it to expand. And as earnings growth expands, the market rally should expand as well.
Of course, our hearts go out to everyone impacted by the wildfires. We haven't seen any sort of major market impact, but is there anything investors need to know as we see events like that transpire?
Yeah, I think in California, and again, my hearts go out to them, my sympathies for all the families that are affected. I certainly have colleagues and people in the industry that have been impacted, and it's terrible. But we'll look at those utilities that are impacted right now, perhaps some of the municipalities overall. Look at the insurance companies. I understand it could be anywhere from a $20 billion to $30 billion impact in terms of total losses that's going to be covered. But I do anticipate the federal government, local government, and these insurance companies to be able to help those affected. And it's going to be a long road ahead for these people that have lost everything. But I do anticipate they will recover.
Kevin Mon, President and Chief Investment Officer at Hennian and Walsh Asset Management. Kevin, thank you.
My pleasure, Chris.
It's great to have you. All right, well, coming up, a college football expert is going to break down a Monday's title game as the College Football Playoff Executive Director makes his way to that opening bell podium here at the Stock Exchange. We'll have more up next.
Obvious Ventures is a firm renowned for its world-positive investing approach, focusing on companies that aim to make a meaningful impact across industries, and has been instrumental in backing some companies that innovate in sectors from food and energy to health and beyond. To talk more about the trends and technologies that are reshaping industries while fostering positive change is the co-founder on this episode of Taking Stock. So I do want to talk to you about your world positive approach. Talk to me about this concept, the motivation behind starting it, and what it really means.
We started Obvious 10 years ago, and we started with this contrarian idea that the biggest companies of our time would be companies solving humanity's toughest problems. So think about the climate crisis, chronic disease, income inequality. We want to use venture capital to fund breakthrough technologies to improve and solve those problems, to make every American's life better. And that's what we mean by world positive venture capital.
And talk to me about the industries that you focus on that help achieve your mission and your goal.
Well, we invest in these 3 pillars: planetary health, health. So that's about decarbonizing the economy, generating renewable energy, electrifying transportation. We invest in human health, and that's everything from better for you food to better healthcare companies and better biotech companies. And then lastly, we invest in economic health. And that's really about helping people find and do their best work. How do we help Americans get better jobs, get better trained?
And across these three sectors, what are the biggest trends you're noticing right now? And how do you identify which companies you want to invest in?
Well, there's one trend that spans all three of those pillars, and it goes by two letters, AI. I suspect this has come up in other conversations, but we're seeing AI as a major technology disruptor, and in particular for us in planetary health and human health.
Good morning, everyone, and welcome back to NYSE TV Live. I'm Kristen Scholler here in studio at the Stock Exchange. Now, although the College Football Playoff National Championship game doesn't kick off until Monday, there is plenty of excitement leading up to the big day, including today's opening bell. I want to send things over to my colleague, Trinity Chavez, with more. Trinity, good morning.
Hey, Kristen, good morning. That's right. Two of college football's most storied programs, Ohio State and Notre Dame, will compete for the national title on Monday. But that's only part of the story. This is the first year of the expanded 12-team college football playoff format. While the top four seeds each received a first round bye, Ohio State and Notre Dame successfully took the more difficult path, of course, winning 3 straight games to reach Monday's championship game. Joining me now to talk more about this is Brandon Marcello, college football reporter for CBS Sports. Good morning.
Good morning. How are you?
It's great to have you on the show this morning. Thank you. So let's kick off this conversation, pun intended, by discussing the game at hand. What should we expect when the teams take the field on Monday?
Well, you got two teams, as you said, that took the most difficult path that's possible going to the national championship game. And really, two blue blood programs in college football. They've combined for 21 national championships in their history, but also teams that not a lot of people believe could make it to the national championship game. Ohio State lost 2 games in the regular season, including to their rival Michigan in their final regular season game in a big upset, one of the biggest upsets of the year. And Notre Dame as well, in week 2 of the season, lost to Northern Illinois, a small program that ended up losing a lot of games itself, but also lost to a 3-9 team later in the season. But Notre Dame had no room for error. They had to win out, and now they come into this national championship game with the country's longest winning streak, and doing so with an impressive defense. Both teams top 2 in the nation defensively, carried by those defenses. But Ohio State, they've been explosive offensively here lately, especially in the playoff, and that's really what's got them rolling here into Monday night's game.
And Brandon, in the old 4-team college football playoff format, both of these teams wouldn't have even made it. Notre Dame is the 7th seed and Ohio State is the 8th seed. Do you believe in its first year the format worked?
Yeah, I think so. There are some tweaks that are going to come to the 12-team playoff potentially. A lot of talk about the seeding process. As you mentioned, the 4 highest-ranked conference champions get first-round byes. And as a result, a program like Notre Dame, which is an independent and not in a conference, will always, no matter what, if they make the playoff, have to play a first-round game because they're not in a conference and have an opportunity to win a conference championship. So there's talk about just ranking the teams 1 through 12 and then putting the top 4 teams, no matter what conference they're in or even if they are in a conference, giving them a first-round bye. There's a lot of talk about that. And then even further down the road, in a couple years, they're talking about potential further expansion, going from 12 teams to potentially 14 or maybe even 16 teams.
Now, all 4 teams that received a first-round bye, Oregon, Georgia, Boise State, and Arizona State, lost in the second round, 3 of whom lost by double digits. Do you see the CFP tweaking the format again within the next few years?
Yeah, I think so. I think we could see something as soon as this upcoming year, specifically when I talk about the seeding process. I think that we could potentially see something much along the lines, if you're familiar with the men's basketball tournament, where a certain amount of conference champions get automatic berths into the playoff. They're getting that spot in there, but they're not going to be guaranteed a certain seeding. So in this instance, the top 4 conference champions, no matter where they were ranked, they were guaranteed one of the top 4 seeds, and as a result, got a first-round bye. I think there's going to be a lot of push to do away with that system.
And you know, in just the past several years, we've seen college football move from the old BCS system to the 4-team playoff and now a 12-team playoff. When do you believe that there will be further playoff expansion, perhaps to 16 teams?
Yeah, I think here within the next 2 to 3 years, there's a new TV contract that'll go in place with ESPN starting in 2026, and that's kind of the target for everybody. That if we're going to expand this thing, we're going to go from 14 or to 16 teams, starting with the 2026-27 season when that new TV contract goes into place. There's been a lot of discussion about this really for the last year or two, because when the college football playoff was being discussed and an expansion at that point we had 5 power conferences. And now we only have 4 power conferences because there's been a lot of consolidation and realignment within conferences over the last 2 to 3 years. So the game has changed quite a bit, so to speak. So they got to tweak things to kind of coincide with what college football looks like today, and for that matter, what it's going to look like in the future, because there could be more consolidation coming up in the future. So they got to keep their eyes on that as well.
And you know, Notre Dame, famously a college football independent, earned a total of $20 million by reaching the championship game. In this era of college football, with the NIL and soon revenue sharing, how significant is this?
Well, it's big. I mean, Notre Dame's already one of the richest programs out there, but every program in the country along in the power conference era, and also because of Notre Dame being considered a power conference team despite not being in a conference, they're all on the hook for having to pay $20.5 million to their players in revenue sharing starting in July. And that's a lot of money, even for these programs that have $120+ million in revenue every year, because this is an absolute new line item in the books for them, and they're not really prepared for it over the last couple of years. So a lot of programs out there are asking their boosters to kind of donate money to funds to help coincide with all this and kind of offset it. And not a lot of programs out there are going to be able to meet that minimum, so to speak, that everybody's wanting to hit. And so I should say minimum, I should say maximum. Everybody's wanting to pay the full share there to football, a lot of it to football. And as a result, a lot of these programs are kind of just scratching by, trying to figure out how to get the money along. So Notre Dame is not going to have any problem paying folks because they are one of the richest programs out there. But getting $20 million from the college football playoff or making it this far certainly helps things, and helps them really for the future as well, as they kind of put some money back just in case things go up even further, the price to play football.
And now, Brandon, before we go, I have to get your prediction. Who do you think is going to win Monday's game?
I think Ohio State will end up winning it. They're the more talented roster. It's the richest roster in college football remaining right now. They spent about $20 million on their roster. Notre Dame's defense, though, I've been very impressed with them. Right now, I'm going to say Ohio State because they're so explosive offensively. But if you're following the odds makers in Las Vegas, I think potentially I'm leaning toward Notre Dame covering that small spread right now in a close game, but Ohio State pulls it out.
Well, I'm definitely going to be talking to my brothers about this because they're in Vegas right now, probably placing their bets. Brandon, it was great to have you. Brandon Marcello, college football reporter for CBS Sports. Now, coming up, big banks are looking to cash in this earnings season. One analyst tells us what he expects to unfold across the sector this year. Stay tuned.
Welcome to Floor Talk. It's great to have you on the show today.
It's great to be here, Judy, and it's a real privilege to talk to you.
So you are the CEO of Agilent.
Yes.
Tell me about the company and what you do.
We're the people behind the scenes that keep your water safe, your food safe. We advance therapeutics, so we test pharma and biopharmaceutical drugs as they're released. So we're the people behind the scenes keeping the world safe.
Now, you held your investor day today at the New York Stock Exchange, and you introduced a new strategy. So tell me about that strategy and what it means for your stakeholders and the industries that you serve.
We're becoming more customer-first strategy, so it's a customer-led strategy led with our markets. So our 3 main markets are pharma, biopharma, clinical and diagnostics and applied. So we're really leading with our markets and seeing how we can bring more solutions to our customers and faster innovation across these markets. So we're really excited about it, and we've also launched a transformation in the company called Ignite. And that's really to help with our customers, making it easier for them to do business with us, for employees, making it a bit easier for employees to work and be more productive, of course, and for customers and our shareholders, of course, to continue our growth.
Now, can you share more about these high growth opportunities and the solutions you're providing for them?
Yeah, I can share one really good example. So Forever Chemicals, you probably heard of that, PFAS molecules and compounds. We test for that globally, so it's a big emerging business for us. So we are the ones that help testing labs test for these molecules. And to give you a sense of our detection limits on our equipment, think about a drop of water in an Olympic-sized swimming pool. That's the level of detection we can do for these compounds, and it's, of course, moving into different modalities, so we're there to really test for these compounds.
Now, today you rang the opening bell to mark the 25th anniversary as a public company.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio at the Stock Exchange. While earnings season is always unpredictable as companies report their latest figures and provide forward guidance, one thing remains a constant, and that's banks kicking off the season. After industry giants and NYSE-listed companies like JPMorgan Chase and Citigroup reported earnings on Wednesday, Bank of America and Morgan Stanley were among firms reporting this morning. And for more on this, I want to bring in Chuck Lieberman, Chief Investment Officer and Managing Partner at Advisors Capital Management. Chuck, it's great to have you on the show this morning. And what are your takeaways from the results we've received so far?
Well, just as you said, they reported better than expected earnings, and that's really a very positive sign for the economy and the markets. People have been nervous about the banks basically for 2 years after Silicon Valley Bank melted down in a classic mismanagement case, but they took out all the banks and shot them all, and so 23 was a terrible year for banks. They've been coming back. But the market's been nervous that an inverted yield curve, a weaker economy, could really damage profitability. And in fact, we're seeing quite the opposite. The yield curve has steepened. The banks are reporting better than expected earnings. And the outlook is very positive, especially if the new administration cuts back on some of the regulatory tape that's constraining banks. So we expect them to do well in this environment.
Mm-hmm. And of course, it looked like investment banking, trading, these all benefited banks, the big money center banks, that is, in the latest quarter, as well as the net interest income, as you alluded to earlier, Chuck. Are the banks able to move in the same direction together, or are they unique and do they move separately?
Well, they tend to move together because a lot of the driving force behind their profitability is common to the whole sector, not just the large banks, but even to a large degree, mid-sized and smaller institutions. The large banks are a bit different because, first of all, they're much more diversified, but secondly, they also have much larger capital markets activities. The smaller banks have much more exposure to real estate, and that's where there is some nervousness because of commercial office buildings, which are still struggling. Mm-hmm. But the larger banks are going to do very well if capital markets activities pick up, as they've started to do.
What does this portend about the rest of the earnings season?
It implies that the economy is doing well, and therefore we should expect good, solid earnings growth across the board. Obviously, that's a general statement. When you get into specific industries, some are doing far better than others. So there are going to be significant variations across the board. But nonetheless, the backdrop is very positive. And right now, looking at the economy, growth is solid. We saw a very strong jobs report. There's every reason to think that that's going to continue. And then we have the new administration coming in, and there are some risks there. Some of their policies do pose risks that inflation might not come down as much as the Fed wants or the market wants, and that's a problem for interest rates.
Mm-hmm. And now, of course, we'll get regional banks. They'll be reporting after we get through the big money center banks, but Bank of America this morning exceeding expectations after the other names like we've mentioned, JPMorgan Chase and Citigroup also beat. What do you expect from the regionals, Chuck? How might they be different or perhaps the same to the big money center banks?
Well, they should benefit from the net interest margin. That's again common to all banks. So they should also see improvements there. Then when you get beyond that, you get into things like real estate. The real estate market is doing fine with the notable exception of commercial office buildings, but that one seems to be bottoming out. But regional banks, of course, have a lot of local exposure. So it depends on what region you're in, what your locality is doing. If you have a lot of vacant real estate, that's a problem.
And I'm curious, in terms of your outlook for stocks, Chuck, we've had many guests on the show who have said we should expect volatility this year, but that by and large, they still anticipate that the S&P 500 will end 2025 in the green. Given these inputs early on this year, what do you expect?
Well, volatility is an easy thing to forecast. The stock market's a roller coaster, so one should always assume volatility in the market. In terms of the market overall for the year, as long as the economy is doing well and interest rates don't surge to the upside, which I don't expect, then corporate earnings is going to drive stock prices, and corporate earnings are likely to do well. I see them as doing well this quarter, but really probably gaining some momentum over the course of the year. So I'm pretty positive on the outlook for stocks generally. Within the market, you do have to look at differences that are very substantial. So we have the Mag 7, and the Mag 7 has carried the market for quite a while. But the rest of the market, the S&P 493, which is unloved and really relatively cheap, I think as long as their earnings do well, they should start to catch up.
Chuck Lieberman, Chief Investment Officer and Managing Partner at Advisors Capital Management. Chuck, thank you.
Thank you.
All right, well, stay with us because up next we will have the opening bell.
On this episode of Taking Stock, we are thrilled to have May Habib join us. She is the CEO and co-founder of Ryder. We're going to be speaking to her about how they are bringing generative AI to large enterprises. Let's get started.
We've been in generative AI for the last 4 years, working on bringing generative AI to the enterprise. And what we've learned from folks is they need a full solution. LLMs are very powerful, but not enough to very quickly get to value on these mission-critical workflows.
And you know, you recently announced a $200 million Series C funding with some of the biggest and most influential companies backing this effort. Talk to me more about the partnership and why was now the right time to have this fundraise.
We had some incredible corporates join the round: Salesforce, Adobe, Workday, IBM. And there's a real realization that enterprise generative AI, especially where we're going on agentic workflows, requires a real understanding of these real-world mission-critical flows that is just much more complex than folks thought. And I think being able to stitch together multiple systems, multiple departments with generative AI, rewiring these flows, requires really a coalition. And that's what is so exciting about the Series C that we raised.
What are your plans for this new funding round?
Certainly expand the team, expand our footprint, but invest in this next generation of models, action-oriented models that are capable of autonomous action inside of the enterprise with reliability, consistency, security that enterprises need.
Talk to me about how your past experiences have helped shape the ethos of your company today.
I grew up in a small family business and learned a lot about the importance of staying really close to the details.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here at the Stock Exchange. Well, in just a moment, the College Football Playoff will ring the opening bell ahead of Monday's national championship game between Ohio State and Notre Dame. Trinity Chavez has more. Trinity, what do our viewers need to know?
Well, Kristen, today the New York Stock Exchange is celebrating the 2025 College Football Playoff National Championship happening on Monday, January 20th at Atlanta's Mercedes-Benz Stadium, marking Atlanta as the first city to host twice the debut of the 12-team playoff format. And here to ring the opening bell, of course, is Rich Clark. He is the new executive director of the College Football Playoff after a 38-year career in the Air Force. We're going to be speaking to him about his storied career and experience and all of that and so much more just after the opening bell. Kristen, what do we have next?
Let's take a listen to that opening bell as we await Monday's big game. All right, now that is an exciting opening bell. The National College Football Championship up there on the podium. That big game happening on Monday in Atlanta. And we'll be seeing some of those folks on our show in just a moment. Well, as the equity markets are now open for trade, I do want to bring in my next guest, Rick Pitcairn, Chief Global Strategist at Pitcairn, joins me in studio. Rick, as we get off to the races here and stocks regaining some momentum the past few days, how does this market look to you?
Well, it's certainly breathing quite a sigh of relief after yesterday's CPI print. I think the whispers were that number was going to be a little hot. And then people were looking at maybe a down January, which is a bad sign for the market. So a big sigh of relief yesterday. I think we're starting from a pretty advanced place in valuations. You know, we're 2 years into a bull market now. The third year can be tough. It can happen, but we'll have to see what January brings us.
Yes, we will indeed. And of course, this earnings season is now officially underway with the big banks starting to report. What is your expectation?
We've got a lot of expectations built into these earnings. They have to come in. I think any miss is going to be punished. We saw the bellwether big financials yesterday come in with some strong numbers and the day before as well. So far, earnings season looks to be a continuation of what we had in the previous quarters, which is either a meet or a beat pretty much across the board. If they keep doing that, they can justify these valuations.
What kind of portfolio positioning are you recommending to clients as we start this new year?
We're really lucky. We have clients that really do take the long-term in view. We're a 100-year multifamily office. These clients are much more strategic and tactical. So we always believe in having a good chunk of equities on the foundation of the portfolio. That said, you want to be diverse because these evaluations are high. There's risk in this marketplace that I'm not sure everybody's appreciating.
What is that risk that you see?
Well, I think there's policy uncertainty. You know, I think it's really hard to predict how some of these really bold initiatives that come out of the Trump administration are going to work their way through the market in the first quarter of the year. We're really happy to see the ceasefire that in the Middle East that got announced yesterday. We don't know how that's going to work out. And we got valuations almost priced to perfection. So we really need to watch how this rolls out in the third year of what's been a really good time for equity investors.
We have made it 2 years through this bull market. How long do you think it can last?
They can go for a while. You know, I'm old enough to remember the 90s when, you know, you could say the market was overvalued in 95 and we went 3 more years before we really had a setback. But I think long-term investors should say, you know, it's hard to time that exact moment in history when things are going to take a pullback, and just make sure that you have a full range of assets in your portfolio so that you survive whatever the market brings you.
I think that's a good takeaway. And of course, we know valuations very much in focus as well, right? We talk about some of the volatility. Some of these richly valued names might be at play in that regard. What more can you tell us about valuations?
Well, I think, you know, why don't we look around and find some companies that might not be at the peak of valuation. You know, you've seen since they announced Robert Kennedy at HSS, the healthcare sector's taken a hit. These are long-time, strong dividend-paying companies. They have a long-time record of solid and predictable earnings. Maybe look in that sector for a company like J&J that's gonna be a little less on the knife edge of valuation and expectations.
Interesting. Now, any pullback usually is healthy, right? In a bull market, even some would say a correction, a 10% pullback maybe once a year, that generally is healthy. Do you agree?
Totally. I mean, and we should expect it as long-term investors. We shouldn't expect, well, the market's going to do 25% for the next 5 years running. It never does that. And we should realize that and take advantage of it in the way that we build our portfolios rather than be surprised by it.
Yeah, I think that's good insight there. We have a big deal coming to market today. FlowCo, an energy equipment provider, priced above the range, one of the strongest deals that we've seen in this space in years. What signal does that send?
A couple to me. I think the IPO market is bound to be stronger under the new administration. It's going to be a little less stringent on regulations. Everybody thinks so, and you're going to see some stronger pricing, more vibrant IPOs. And I think the energy sector, natural gas, drilling, nuclear, it's the really derivative beneficiary of what's going on in AI. What we're going to need as a society is a lot of power, wherever it comes from, and companies like this are poised to benefit from that.
What do you think about international stocks? We talk so much about the U.S., especially with the new administration. Is international something that you think is worth diversifying into?
I think we should have a core piece there. It hasn't worked since 2009, basically. But the dollar's very strong right now. The dollar just went on a run. I think at some point we get some dollar weakness, and if that happens, you'll have a strong representation of your international stocks. And if you're concerned about valuations in the U.S. and in those tight markets of the U.S., you do get some relief from that in the international markets.
Mm-hmm. Rick Pitcairn, thank you so much for joining me. Rick is the Chief Global Strategist at Pitcairn. We really appreciate it.
Thanks for having me.
All right, well, coming up, the chief economist of the National Association of Realtors is going to break down how recent inflation and looming housing data could impact mortgages. Stay with us.
Colleen, welcome to Floor Talk. It's great to have you on the show.
Judy, thanks for having me. I'm so excited to be here.
So, Colleen, you joined Planet Fitness as CEO in June. So tell me about your first 6 months.
It's been a very fast first 6 months. I've really leaned into spending time in our clubs and getting to know our franchisees, talking with our club team members and seeing how our members utilize our clubs. I call it feet on the street. It's been really insightful. And we've also worked on our strategic imperatives and kind of codified our roadmap for our growth ambition.
So tell me about your growth strategy and vision for the future of Planet Fitness.
Our 4 strategic imperatives really start with refining our brand promise and then making sure we pull that through in our marketing messaging. We're also leaning into member experience to make sure that we're connecting with our membership and enhancing our relationship with our members and delivering a format both inside and outside the clubs that's most meaningful for them and is going to enable them to accomplish their fitness goals. And then we lean in on format optimization and our equipment mix. And that's making sure that we've got the right mix of equipment for how our members want to utilize our clubs today. And when we get all of that right, and we're thoughtful about unit economics and build cost for our franchisees, it enables us to turn up the afterburners on growth.
Now, how will you redefine your brand strategy and communicate it effectively?
We're growing stronger together, and we're all strong on this planet. We're seeing across generational cohorts a focus on utilization of strength in our members' workout routines and our prospective member workout routines. So as we've done.
Welcome back to NYSE TV Live. I'm Trinity Chavez at the New York Stock Exchange. Now shifting gears to the housing market, fresh economic data is in, and it's painting an interesting picture as we kick off the new year. Plus, with a strong job market and wage growth outpacing inflation, how are these factors shaping the real estate landscape? Well, to break it all down, we are joined now by Lawrence Yoon. He is Senior Vice President of Research at the National Association of Realtors. Lawrence, it's great to have you with us.
Good morning, Trinity.
Now, let's just get into this fresh data. What does the latest inflation data from January 15th tell us about the current state of the housing market?
Well, it is a good news on the inflation front. Now, of course, the headline figure actually rose from the prior month, but the data that I am looking at is the housing shelter inflationary pressure, and it was the lowest in 3 years. It's still notching up at better than 4%, but the private sector data is essentially saying it's not rising, so I think there's more room to calm down, which means that overall inflation will be much calmer later in the year. And I think that will allow the Federal Reserve to make deeper rate cuts as inflation comes down.
With 2.2 million jobs added just last year and strong wage growth, how is the robust labor market influencing housing demand overall?
It's very good that the labor market is still solid because in order to buy a home, one has to have a job. But what we saw is that in the past 2 years, even with job creation, home sales did not rise. And the reasoning for that was mortgage rate keep rising. And the funny development was ever since the Federal Reserve cut interest rate in mid-September, mortgage rates have risen from that time. So we have a gap between mortgage rate along with what the Federal Reserve has been doing. But I think it's just inevitable that the mortgage rate will settle down towards about 6 to 6.5%, say mid-year this year, later. Don't expect 3%, 4%, 5% mortgage rate, but the new normal of 6% stabilizing, job gains, inventory growth, these are positive development or more home sales, which will help contribute to economic growth.
And with consumers actively looking for inventory, how are builders responding to the increased demand, and what's the outlook for the new housing market, as it's kicking off this year?
One can just look at the stock prices of the builders. Lennar, KB Homes, Toll Brothers, it is up substantially from 2-3 years ago. So there is an optimism. There is capital available, and we still have a lingering housing shortage. So the builders just need to get more active. But what we are also finding is that many existing homeowners are also beginning to list their property from life-changing events. Perhaps there is a new job in different part of the town requiring relocation or additional child in the family and people have to trade up, or people are retiring and they want to trade down. So all of these life-changing events constantly occur. So with the passage of time, the lock-in effect becomes less strong, so more inventory coming onto the market.
And you've talked about this before, but is there an oversupply in the apartment sector? And do you think that's likely to affect housing affordability and the broader real estate market?
You pointed out a very important part where we have a temporary oversupply of apartments, or new apartment units still hitting the market even as the vacancy rates are rising. Now, there is still demand for apartment units, but the supply is outpacing demand, and therefore the rents are not rising. And this is a indirect relationship with mortgage rate, because once the rents calm down, that means that Federal Reserve will see overall consumer price inflation to be much better behaved and allowing the Fed to cut interest rate, and the mortgage rate, I believe, will be following that path, unlike what has happened recent months. So as the inflation comes down, mortgage rate will follow the path of the Federal Reserve.
Lawrence, are there specific regions or markets that you're following where you're seeing home sales are jumping or showing significant gains due to improved inventory levels?
We are seeing a great activity, for example, in Charlotte, North Carolina, Knoxville, Tennessee, in the area with job growth, relative affordability, and inventory showing up. The Midwest of the country, Indianapolis, Kansas City, homes are just generally very, very affordable. So someone who has the flexibility to work from anywhere, consider the Midwest America. But one point that I'm watching carefully is the devastation what's happening in Los Angeles from the fires, because there was a massive housing shortage to begin with. Now we are removing some housing stock. The rents will be rising quite strongly in the LA surrounding area temporarily. But what we find in the overall long term following a natural disaster is there's always a recovery. So we do anticipate recovery. and just right now there is the difficult housing shortage situation in the LA market.
Now, briefly, Lawrence, I'm interested to get your take on if you think that increased productivity and production in the construction industry can help mitigate rising costs and stabilize mortgage rates.
Oh yes, absolutely. Because one of the barriers to buying a home was the affordability challenges. So to the degree that more homes can be built more cheaply, maybe modular production, more assembly at the factory, and then move it into the land site. All these are positive development, higher productivity, and more access for middle income, moderate income families to purchase a home.
Thank you so much, Lawrence, for all of those key insights. Lawrence Yoon, Chief Economist and SVP of Research at the National Association of Realtors.
Thank you.
Coming up, FlowCo will begin trading here at the NYSE today. The company's CEO is going to sit down with us a little bit later, just after this break. Today we're talking about the future of dining with an iconic brand, P.F. Chang's. With 300 restaurants around the world, they're taking a bold new step into fast casual dining, a new concept called Pagoda. And I have the CEO here to tell me all about it, only on Taking Stock. Now, obviously your focus is your 300 P.F. Chang's that you have around the world. But talk to me more about this new Pagoda concept.
The type of service and food that we serve, which is made from scratch, high quality ingredients, great hospitality, great ambience, that can be used in more use cases, more need states, more occasions, more people more frequently. So the light bulb moment, if there's one, is wait a second, we can do a great job for you on a lunch during the week. And, and it can be very fast, it can be very affordable, it can be very, very abundant, and of course, delicious. We just have to adapt the way we do things, steps of service, abundance, price points, to be able to serve you this way.
Now, while you're remaining so agile with this ever-changing landscape in the food and beverage sector, how do you sustain your authenticity?
The brand has to know, what they stand for, right? In our case, is every day is a celebration. We want to elevate every occasion and make it special to people, right? So if it's a day-to-day lunch, we created a concept here in the US that we call Express Lunch in our bistros, which is a lunch in 20 minutes or lunches on us. It's the same ingredients, same kitchen, same steps of service, just an individual bowl because that's the occasion there. So understand who the brand is, what the brand stands for, and what the consumer, the customer, in our case, the guests, the way they want to live their lives and adapt ourselves.
Welcome back to NYSE TV Live. I'm Trinity Chavez. Now, earlier this hour, College Football Playoff Executive Director Rich Clark rang the opening bell ahead of Monday's national championship game between Ohio State and Notre Dame. Rich is joining me now in studio, fresh off of the Bell podium. You just rang the opening bell, kicked off trading for the day. How are you feeling?
I feel exhilarated.
Yeah.
It was just awesome. I knew it was going to be really cool to do it. But when you're actually standing there and taking it all in, it's just exhilarating, really.
Well, and we were talking briefly about how you were here 20 years ago on the trading floor of this iconic institution. And did you ever envision yourself that you would be on that Bell podium, kicking off trading for the day to celebrate this day, this kickoff, so to speak?
Never imagined I'd come back. We were here, I was a White House fellow, and our class came and we were on the floor. But I would have never imagined that I would be on the stand, ringing the bell, starting the day. It's just amazing.
But talk to me about the significance, not only to you personally, but also CFP as a whole.
Well, this is the first year of the 12-team playoff, so it's a whole new format that we're starting. And we've gone through the first round, the quarterfinals, and semifinals, and on Monday is kind of the grand finale between Ohio State and Notre Dame. And so we're making history in college football. And so it's exciting to be able to kick it off here and to start it off in a way that I never imagined we would.
And you know, your background is interesting because you began this role after your distinguished career, a 38-year career in the Air Force, retiring with the rank of Lieutenant General.
Yes.
Talk to me about what interested you specifically about where you sit today.
Well, I did play college football at the Air Force Academy, and I was the superintendent of the United States Air Force Academy before I came here. So when I was approached and asked if I wanted to put my name in the hat, for me, it brought the things that I love most outside of the Air Force. I love football. I love being able to give back to a sport that did so much for me as a young man, and also to give back to student athletes who are on that same journey right now. These young men are where I was 40 years ago, so the opportunity to be a part of their lives is great.
What do you think is the biggest challenge, or was the biggest challenge for the committee when building out this 12-team bracket format?
Well, you don't always know what's going to work and exactly the format that's going to be perfect, right? We knew we weren't going to get perfect the first time, but we built it out in the best fashion we could, and our goal really is to make it spectacular, as spectacular as it can be with this format, and then we'll tweak it and make it better every year. But trying to get the right teams in, seeing the games happen, and then watching it in the championship game is just going to be amazing.
Now, this year's playoff included 4 bye teams, all of whom won their conference championship and all of whom lost in the second round.
Right.
Can you talk to me about what you see for the future of this, and do you see this kind of criteria changing to 4-team?
It could happen. Really, it's up to the conference commissioners, and we at CFP, we're going to present them with options, and our conference commissioners are really the ones that manage the format. They are the leaders of CFP, and so they're going to take a look, see what the pros and cons, what worked and what didn't, and then we'll adjust from there. But I think it's going to take us a couple of years to get it exactly right. But that's with anything. You're always looking to get better every year, every step of the way.
It's so funny because my manager always says we want to get 1% better each day. And it's about celebrating those small milestones because, you know, when you add them all up, it makes a difference.
That's right.
Well, thank you so much, Rich. It's a pleasure having you on the show. Again, Rich Clark, Executive Director of the College Football Playoff. Now, we also have an exciting closing bell this afternoon. For more on this, I do want to send things over to my colleague, Kristen Scholler. Kristen.
Trinity, thank you so much. Well, the big IPO of 2025, the first sizable listing this year, is happening here at the New York Stock Exchange, and it's in the energy sector. FlowCo Holdings raised $427 million in its U.S. IPO, pricing shares at $24 apiece. That was above the expected range. The company is debuting at the stock exchange under the ticker symbol FLOC amid strong equity markets and optimism about a new administration and regulatory environment. Joining me now with more is Joe Bob Edwards. He's the CEO and president of FlowCo. Joe Bob, welcome and congratulations.
Thank you. Thank you very much. Great to be here.
The first sizable listing of 2025. What made now the right time to go public?
Our company has been around for over a decade, and the energy space in the United States is so exciting, and we're thrilled to be a part of it. And I think the company deserves a permanent capital base that a public listing offers, and we're just thrilled to be here at the finish line today.
You're going to be ringing the closing bell as we await the opening trade for FlowCo, an energy equipment provider. Give our viewers more color as to what your company does.
Absolutely. So the United States produces more oil and natural gas than any other country in the world. That has been made possible by all of the innovation that has taken place in the United States shale production. We sit at the critical path for our oil company clients in their production phase. Once they drill and frack a well, they then have to produce it for, in some cases, 20 years. We offer the right solutions to those customers to enable that production to be handled more efficiently.
And for potential shareholders out there who are listening to this interview, what should they know?
We have an amazing growth opportunity ahead of us. The specific technologies that we offer to our oil and gas company clients are in high demand. We think that there is a tremendous opportunity for us to continue to grow organically by deploying our free cash flow into new systems that we will put out on rent to our clients.
Why is the stock exchange the place that you wanted to take this IPO?
This is the very cradle of American capitalism. We are so honored to be a part of the New York Stock Exchange, and this is an exciting day, not just for me, but for all of my employee partners.
Let's talk more about what's going to unfold today here at the exchange for you and your employees. What can you tell us?
Well, we're going to ring the closing bell, which is an amazing opportunity. I have my family here. I've got over 40 employee partners here. A total guest list of over 150 people will be witnessing the ringing of the bell, and we're just thrilled to be here.
As we start 2025, Joe Bob, what are your goals for FlowCo this year?
Well, we've got to actually deliver on what we've been telling investors we're going to do, which is to continue to grow, to continue to be good stewards of capital. We've now got over 300 shareholders in the business after our IPO today. So we've made some commitments to them. We hope to honor them. We hope to exceed their expectations. So after this weekend, we're going to take a breath and then get back to work.
And in terms of the work that is yet to be done, of course, you have a large employee base. You're a multi-billion-dollar company pricing this deal above the range. What kind of enthusiasm does that bestow in your employee base to get the work done?
We're incredibly proud of the employee partners that we have. At the IPO, we're creating 40 millionaires who have been with this company for, in some cases, over a decade. So very proud of that. However, all of them know that today, in many ways, is just the beginning. We're embarking upon a new chapter for this company, and the sky's the limit. We have an amazing opportunity ahead of us to continue to serve our clients. We look forward to doing that.
What makes FlowCo unique within the energy and gas space?
We focus on production. So you have to drill a well, you have to frack a well, then you have to live with it for 20 years if you're the owner of that well. We're very unique in that we're the only company that focuses exclusively on production optimization and artificial lift technologies.
Joe Bob, it's a pleasure to have you. Congratulations again. We will be down on the floor for the opening of FlowCo and, of course, cheering you on for the closing bell as well.
Excellent. Thank you for having me.
Our first big listing, the first big listing of 2025, happening here at the New York Stock Exchange. That's Joe Bob Edwards, CEO and President of FlowCo. All right, well, we are just moments away from wrapping this show, and I do want to bring in my colleague, Trinity Chavez. Trinity, some great interviews that we've had throughout the hour today. Massive deal from FlowCo, multi-billion-dollar company. We're awaiting that open, as well as the opening bell ringers who you spoke to earlier.
Yeah, no, absolutely, Kristen. And I have to say, I really enjoyed listening to your interview with the FlowCo CEO, and we're going to hear the crowd cheer just behind us when we hear that first trade bell happen, especially as it priced above range. So, what a great way to kick off 2025. And I know that we're gearing up to cover more IPOs here on the show.
Absolutely, indeed. We will be covering those, of course, throughout the weeks and months to come. And we've got that College Football Championship set to take place on Monday. Of course, those were the bell ringers today. Trinity, enjoyed your conversation there with some members of the Bell Podium, Notre Dame and Ohio State. It's going to be a big one.
Where are you going to be watching the game?
I am going to be watching the game, Trinity, from my home, and I'm going to pick Notre Dame for this one.
Yeah, I still have to, I'll make my decision by end of day, but I'm definitely going to be watching the game on Monday because I'm going to be interested to see who obviously wins this big one.
It is a big one indeed, and viewers, thank you for watching. As always, we've got another big one tomorrow, another show 9 a.m. Eastern. We'll see you then. For the whole NYSE TV Live team, thank you for watching.
Thank you for being innovators in the market. Thank you for all you do every day to show the world what best in class truly means.
We are incredibly proud to join the ranks of other highly successful companies who partnered with this legendary institution.
What a time to be here. I am so proud of what we're doing.
This is a huge milestone for our business. There's a lot of people responsible for getting to where we are today.
We have a role to play in bridging the gaps that exist today between us.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. I'm so optimistic about what lies ahead. It has been a privilege to be with you.